Did you know that 90% of investors lose money in the stock market? Shocking, right? And here's something even crazier. The average investor underperforms the market by almost 2% every year. If you're looking to become rich, avoiding common mistakes is crucial. And guess what? Most of these mistakes are avoidable, if you know what to look out for. In this video, we'll uncover 6 huge traps that could be keeping you from building real wealth. These aren't the typical things you've heard a million times before. We're diving into strategies that top investors like Warren Buffett swear by, yet most people ignore. So, if you want to stop losing money and start investing smarter, stick around. You'll learn exactly what to avoid to set yourself on the path to financial success. Ready to discover what's holding you back? Let's dive in. Chapter 1. Chasing Fads. Why hype won't make you rich. We all love the excitement of a hot new stock, but chasing after trendy investments is a quick way to lose money. Take the dot-com bubble, for example. During the late 90s, investors poured money into tech companies based on hype, not solid business fundamentals. In 2000, the Nasdaq lost over 75% of its value, wiping out billions. Warren Buffett, a longtime value investor, once said, "Price is what you pay, value is what you get." Simply put, hype doesn't guarantee value. In value investing, the focus is on long-term growth, not short-term thrills. Remember, Facebook wasn't always the tech giant it is today. Its stock, after going public in 2012, was once under $20. But savvy investors who understood its true potential saw the value, not the buzz. If you're looking to get rich, avoid falling for the next big thing, just because everyone's talking about it. Look at Bitcoin's wild ride as another example. The cryptocurrency's price skyrocketed in 2017, only to fall dramatically in subsequent years. Investing based on FOMO, fear of missing out, isn't a strategy, it's a gamble. In contrast, value investing relies on finding companies with strong fundamentals rather than chasing after the latest trends. The lesson here is clear. Focus on solid, time-tested companies with growth potential rather than chasing after the latest trends. Hype might look good on paper, but it rarely lasts. Chapter 2. Overlooking the power of patience. The silent killer of wealth. We live in a world of instant gratification, but wealth takes time. Patience is a cornerstone of value investing, and those who overlook it often miss out on huge opportunities. Warren Buffett's success wasn't overnight. In fact, he didn't become a billionaire until he was in his 50s. The key? Patience. In the stock market, you might hear people talk about getting rich quick, but the truth is, real wealth comes from holding your investments long enough for them to compound. The S&P 500 has returned an average of about 10% per year over the last 100 years. While that might not seem like much, compounding that small percentage annually leads to massive growth. Think about it like this. $1,000 invested at a 10% annual return will grow to $10,000 in 25 years. Now, if you're constantly selling your stocks for small, short-term gains, you'll never see the power of compounding. Patience helps you hold onto those stocks and see the results. To quote Buffett again, "The stock market is a device for transferring money from the impatient to the patient." Investors who try to time the market or make quick profits often end up losing. But those who stick to their strategy, let their investments grow, and reinvest their earnings see consistent returns over time. The reality is that most successful investors aren't the ones jumping in and out of the market. They're the ones holding their positions through thick and thin, and reaping the rewards in the long run. Chapter 3. Ignoring the margin of safety. The risky shortcut to ruin the margin of safety is one of the most critical concepts in value investing. It's the difference between the price you pay for an investment and its true value. If you buy a stock without considering its intrinsic value, you're taking on unnecessary risk. Benjamin Graham, known as the father of value investing, famously said, "The essence of investment management is the management of risks, not the management of returns." This is where the margin of safety comes into play. A solid margin of safety protects you if things don't go as planned. For instance, imagine you're buying a company that's worth $50 per share, but the market is selling it for $30. This $20 difference gives you a margin of safety. If the company faces a downturn or if it's temporarily undervalued, you have some cushion to absorb the loss without losing your investment. This principle is why value investors are willing to wait for a stock to be undervalued before buying it. They don't buy a stock just because it's popular or because it looks like a good deal on the surface. They analyze the company's fundamentals, its earnings, cash flow, and long-term prospects before making any move. The margin of safety also helps you sleep better at night. By ensuring you aren't overpaying for a stock, you reduce the chances of significant loss if the market turns against you. Companies with strong fundamentals, a track record of profitability, and solid growth potential can weather downturns, and your margin of safety will shield you from most of the damage. This is why some of the greatest investors, like Warren Buffett, insist on only purchasing stocks when they are available at a significant discount to their intrinsic value. A margin of safety isn't just a buffer, it's the difference between making money and losing it. Before we jump into the next chapters, don't forget to hit that subscribe button and turn on notifications so you won't miss more valuable tips on becoming a smarter investor. Chapter 4. The illusion of diversification. Why more isn't always better. Diversification is often considered a golden rule in investing, but it's crucial to understand that more isn't always better. Many investors believe that owning hundreds of stocks will protect them from risk, but over-diversifying can actually dilute returns. Warren Buffett has said, "Wide diversification is only required when investors do not understand what they are doing." If you're constantly spreading yourself thin, you might miss out on the potential for substantial gains. Take a look at Buffett's own portfolio. It's far from being overly diversified. In fact, his holding company, Berkshire Hathaway, has a relatively small number of core investments. His belief is that by focusing on a handful of well-researched stocks, you can better manage risk and earn higher returns. In contrast, most mutual funds and ETFs have dozens, even hundreds, of holdings. While this may provide safety, it often means mediocre returns because the success of the few outperforming stocks is watered down by poor performers in the mix. A study by Vanguard found that the average active mutual fund underperformed the S&P 500 by about 1.5% per year over a 20-year period. By concentrating your portfolio in a few high-conviction investments, you can monitor them more closely, making it easier to react to changes in the market. With fewer stocks, you can dive deeper into the financials, management, and growth prospects of each one. This is the essence of value investing, researching and understanding your investments thoroughly before you commit. Buffett's advice is clear: put all your eggs in one basket, but watch that basket very carefully. It's not about spreading your investments thin, it's about concentrating your efforts on finding a few great opportunities and sticking with them for the long haul. Chapter 5. Getting emotional. How your feelings can derail your financial future. One of the biggest mistakes investors make is letting emotions dictate their decisions. Fear and greed can lead to impulsive choices that don't align with your long-term goals. In the stock market, emotional decision-making often results in buying at the top when everyone is excited or selling at the bottom when fear is rampant. This is where a strategy based on value investing, which emphasizes rational thinking, can help. By sticking to the fundamentals, focusing on the intrinsic value of a company rather than its short-term price movement, you remove emotion from the equation. Value investors understand that the market can be irrational, and they take advantage of this by buying undervalued stocks during periods of panic. For example, during the 2008 financial crisis, many investors panicked and sold their stocks. However, Buffett famously took advantage of the market's fear, purchasing companies at bargain prices. In fact, he invested $5 billion in Goldman Sachs when its stock was heavily discounted. The result? A massive return on investment once the market recovered. As Buffett once said, the stock market is a device for transferring money from the impatient to the patient. Those who let fear or greed control their decisions tend to lose money, while those who keep their emotions in check can find opportunities in times of uncertainty. One study by Dalbar, a financial research firm, showed that over a 20-year period, the average investor earned only 2.6% annually, while the S&P 500 returned 9.2%. The reason? Emotional mistakes like buying high out of greed or selling low out of fear. The key to avoiding this trap is developing a disciplined investment strategy. Value investing helps you stay grounded by focusing on long-term fundamentals, rather than short-term market swings. Stick to your strategy, and avoid letting emotions dictate your financial decisions. Chapter 6. The trap of following hot tips. Why outsourcing your thinking is a bad idea. It's tempting to listen to the latest stock tips from friends, family, or influencers. But relying on others for your investment decisions is a dangerous game. Value investing is about making independent, informed decisions based on research, not on hot tips. Consider the example of a popular stock that's constantly in the news, like Tesla. While it has been a strong performer in recent years, buying it just because everyone's talking about it can be risky. Instead, value investors assess the stock's true worth by looking at its financials, management, competitive edge, and growth potential. If the stock is overpriced, it doesn't matter how many people are talking about it. One key principle of value investing is doing your own homework. Benjamin Graham, who mentored Warren Buffett, emphasized this when he said, "The investor's chief problem, and even his worst enemy, is likely to be himself." Investors often get caught up in the excitement of a stock tip without doing their own due diligence. For example, in the 2000s, many people followed hot tips and invested heavily in companies like Enron, only to see those stocks crash when the truth came out. Relying on others' opinions without understanding the company's fundamentals leads to poor decision-making and potential losses. Instead of following the crowd, value investors focus on what matters, the fundamentals of the business. They evaluate earnings, cash flow, debt levels, and management before making any investment decisions. This approach ensures that investments are grounded in solid research, not speculation. An important point here is to avoid chasing short-term success based on others' advice. The media and influencers often promote hot stocks that seem to be doing well in the moment, but those tips don't always hold up over time. In fact, according to a study by the National Bureau of Economic Research, over 80% of stock recommendations from financial analysts do not beat the market. The takeaway? Instead of blindly following others, use their tips as a starting point, but always do your own research. Make sure the company's fundamentals align with your investment goals and your strategy. Successful investing is about patience, discipline, and independent thought, not about following trends or tips. If you found this video helpful, don't forget to hit the subscribe button and turn on notifications. More valuable tips are on the way to help you become a smarter, wealthier investor.